notes are written with like Sharpie markers. So they can see them. Because you can't read any of these notes.
Yeah.
We have notes, but they're no good. Cool. All right, in this segment, we are going to touch base on the industrial market. We got into this maybe 18 months ago, 24 months ago. We started really looking, and we bought a couple deals since then. We have about 325,000 square feet total, and that's it's pretty consolidated because that's not that much in the industrial component, but we're in Georgia, and we bought a portfolio of 6 deals over in Columbia, South Carolina. So we have a good footprint, so we have a little bit of an idea of what we're seeing in the market, but the industrial market as a whole is extensively large.
Yes,
right.
And it's been on fire for a good amount of time. Basically full occupancy, wait lists to get into prices, and double-digit rent growth year over year.
Yeah, and you're seeing, a lot of that too is just the huge facilities that are being built. We're talking 500,000, 700,000, million square foot buildings that are going up that are these big distribution centers. Amazon was a lot of the talk of that for a while around how much space that they were gobbling up. But I would say that is exactly the opposite of what we are buying.
Right.
The typical industrial, if you look or hear about industrial, is going to be 40, 50 foot high clear heights, meaning the interior height of the ceiling is 40, 50, 60 feet high. Now, the very tall buildings, you've got, your loading docks on the back that you have anywhere from hundreds of these things on the backside of a warehouse. So that's not what we're buying, and that's not what our experience is. We are buying essentially 20 to 50,000 square foot buildings that are typically older. We're getting those at a significant discount to price compared to newer stuff that is out there, and it's a very different user. Amazon is not one of our tenants.
Right, and the nice thing about buying properties like this is that they're older, so they're in more established locations, they're more infill. They're basically irreplaceable unless you tear something else down. So our basis of buying these things, give or take $100, $130 a square foot, buying infill, usually your land is going to be 70% of that. And then you have to build on top of that. So the basis that we're buying at is irreplaceable.
Yeah, we've always been buy at below replacement cost thinkers. So we're looking at something, we say, wow, that's cheap, and you can't build it for that. Then that's when we get excited when we're looking at stuff. So the industrial space as a whole, though, that market has been red hot. We have seen just market rents that are double or triple what they were a few years ago on pretty much everything that's around. And that's just in our markets. That's kind of in Atlanta and what we're seeing up and down 85 and a little bit of 75 up to Chattanooga.
Yeah, and part of the buying opportunity that we've had is when we go into look for a property that maybe the owner bought 5 years ago, 7 years ago, and they were, at their basis and what they bought at rents were $4, $5, $6 a square foot, and they were happy, and things were great, but they did not take advantage of the market that has moved. That we're now getting closer to $12 a square foot. We can afford to buy it at substantially more than what they pay for it, and also improve it and make it better for the tenants, and then increase the rents and
a lot of the news on industrial is that higher end stuff, right? That's new build coming out of the ground, very different. But we're talking about this infill. A lot of it is owned by long-term owners of real estate that have had it for maybe 5, 10, or 20 years. I think the current deal we're working on, Pleasantdale, they've owned it for almost 20 years. Mm-hmm. Rents are
$4, $5 a square foot.
Yeah, but that has worked. If you bought it 20 years ago, that's all you needed to really kind of cover and maintain and keep the asset. So there's definitely a huge amount of that still out there in the market, right? Of these infill, smaller locations that are available. So we're mostly focused on what that segment of the market is doing. And really, it's not moving that much. A lot of those are longer term tenants. So there's not a whole lot of turnover in those spaces. So if you want a 5,000 square foot infill warehouse space, it's going to be hard to find. It's, kind of the demand for that is exceedingly outpaced what the supply is.
Yeah, so the one-off opportunities that we bought, Doraville is a good example of that, is that the seller relocated his business to somewhere in Florida and vacated 25,000 square feet. And we had the opportunity to go in and break it up into individual bays and and release the property. But that was a pretty unique situation that the seller was picking up and moving and allowing some market vacancy. Otherwise, there wouldn't have been a
there wouldn't have been any. So the only real opportunities we're finding is those unique situations, right? Where we're not looking to build stuff, so it's all really what way can we find where a transition is going to happen that we can become involved in. Right. So if we look about our assets, so we have 6 total deals, and one of those deals has six assets. So we really have 11 total properties, and that combined fits in one of these brand new warehouses. So that's just over 300,000 square feet. We could take all of our buildings, probably even the clear height, and put them in one of these new warehouses. But with that being said, we've had a very strong demand for the assets we do have. So we are essentially full on everything except Covington has 2 vacancies. We're talking about a couple thousand square feet. And Dawson Flex, one of our deals, we have vacancy there. We had planned on having vacancy, but we actually have groups that are coming in prior to us even doing our CapEx or doing our division of assets and trying to take that space.
Right. So. And I think Dawson's a great example of just how strong that market demand is we've spoken to the tenants and we said, hey, listen, we need to improve the place. We need to make it nicer. And we're going to need to increase rents. And they basically said how much, that they had no other options to move to. And so they're looking like, let's share some of the burden together. Maybe you don't have to improve it too much and we can have a little bit lower rents. And we're able to negotiate that and leave them a place to conduct their business.
It's a little bit of a give and take
right.
of what can we do? I mean, we have some exterior work we have to do on stuff to make it usable. Mm-hmm. But we have tenants that are very interested in being in these spaces, and that demand is still there. So that could change, though. I mean, as we're seeing, if we think about the market as a whole right now, I believe the Fed is going to keep pushing rates until they are able to slow demand in some capacity. I'm not sure how far they have to go to do that, but I believe that's their goal. And in doing so, the companies are going to see less demand. So, for example, we had a building that was up in Raleigh where we were trying to get HVAC systems because one went out and we physically couldn't get the right one. So we had to buy a bunch of other makeshift ones in the time being that were available, or using those until we can get the full replacement in. So it's like we're spending a lot more than we should have. In a normal scenario, we'd be able to go in and replace an HVAC system. There would be actual supplies to meet that demand in a timely fashion, and we wouldn't be stuck going out and buying unnecessary units and this kind of juggling act of executing a simple HVAC change. If the Fed keeps pushing rates to kind of slow that kind of crazy demand, that'll bring back, what kind of a 1-for-1 supply and demand on at least HVAC units. But to get there, they probably have to go past that and slow things down a lot more than I think anyone wants to see. But as that happens, we're going to see a slowing in demand for industrial space.
And, with the industrial space we're buying that were built in the 1960s, 1970s, 1980s, we're at times we see kind of a shift in use that sometimes the office is too overbuilt. Sometimes the warehouse is too overbuilt for the tenant's needs. Right now, inventory is the name of the game right now. Everyone needs more inventory to sell, to keep their suppliers happy. So, they need more warehouse space. We see, if supply chain can get back to normal, that might soften the use of the space a little bit more.
Yeah. So that's also being flexible in kind of what tenants want or where they're gonna, where they're gonna fit in the space. We see rates rising though too, and it's gonna make anyone that has kind of leveraged inventory, that's gonna be more expensive to just hold that.
Right.
Especially if you're borrowing money to buy your inventory, it's going to get more expensive to borrow it. You're probably going to want to hold less, probably going to constrict demand for supplies in that fashion as well. I don't necessarily know how that helps the supply chain issues that we're seeing if that becomes more expensive. It's a very intertwined discussion. But in the demand that we're seeing in our space, there's virtually no new supply of what we buy coming online.
Right.
In the past, in the future, it's not something that has been added to, and it probably won't. I mean, there's no way to really buy land and build something like this affordably.
I mean,
you would need to get crazy rents, like $20, $30 a square foot.
I mean, if anyone, we like to heavily buy in the Norcross market, which is really where our office is here. And, you take a Google map look of really Norcross and look out, say, a 3-mile radius from downtown Norcross. It's all built. There is no free land available. If there's anything being built that's new, is tearing something else down. So you're paying quite a bit.
Yeah, right down the street, and they tore down a complex kind of just like ours to build apartments on it. But they're paying that those numbers don't work for shallow bay flex space and 20,000 square foot buildings. That's just not gonna happen.
So we were talking about interest rates. So our portfolio, we have 6 properties, 6 loans on them. All but one is fixed under 5%. The one that is floating has a ceiling on it, and it's tied to the SOFR rate. So we feel like we're in pretty good position over the next 5 years or so to improve these properties, release them, get higher rates, and ride out this hopefully short duration interest rate storm that we're in.
Yeah. Yeah, even though the one floater rate that we do have is capped at 6%. So it's like, that's not terrible.
That's lower than the rates that we're getting on properties looking forward.
True. So that's still pretty good. Really the kind of managing this new market as things are evolving, as rates go up, we either have to increase revenues to produce more net income so that we can cover a future higher borrowing cost. So when our loan matures in 5 years, it's like, okay, what is rates going to be in 5 years? We're going to need to be able to renew that loan, refinance that loan, extend it, do something with the bank. And at that time, if their mortgage costs double, we're going to need to have that much more revenue to cover that significantly higher mortgage payment, or the value's got to come down. Right. So that's kind of that give and take with interest rates going up. That's either values have to come down or revenues have to go up to cover that spread. The industrial parts that we're in, though, we feel like we have a little bit of an advantage. I mean, I think we do, in that there's literally no new supply added into that space, but we keep seeing additional housing units. It makes sense to tear stuff down and build housing units. So we have density increasing, but the supply components of the flex space still just being the same.
Right. And we're, working with the, in our space with these, specific, short bay flex spaces. The tenants that we're working with all have specific demands. So looking forward, as we look at opportunities, there be very much, kind of a deal pickers market, that there's going to be unique opportunities that we're working specifically with the tenants to improve the property for whatever their current needs are and sign a longer term lease with them and create the value in that way.
Right. Yeah. It's a very niche specific value creation. It's almost like what Andrew did with, the retail side is different than the industrial, but we're taking a tenant and reducing their rent, extending the lease, and the way we're buying it is producing better returns than a short-term higher lease.
Right.
So, there'll be ways that we can find that in the industrial space, but we've got to be very specific of who we work with, a tenant, and what they're looking for. I don't think, if we look at just like bigger box industrial or kind of fixed long-term leases and buying that right now, that seems overly risky. I don't think that's going to work. Those are going to trade at lower cap rates in the future. Right? So you're going to buy something that you kind of know is going to be worth less because there's not a value creation component to it. So we're shying away from those. We're not too bullish on that component. But if we do, and we are able to find tenant-specific ways to add value, like those could be good plays in the industrial space going forwards.
Yeah, like Dawson's a great example that we're working with one of the current tenants to build it out to their specific needs. They're staying, so we don't have to have the downtime and the improvement dollars to turn that over. And a deal that we're working on right now that we're negotiating the final terms of, that we should be bringing out to you guys pretty soon, is really rebuilding part of their warehouse and their parking lot to make it better use for their fit.
Yeah, and that's a single tenant flex deal, industrial flex deal, where we can go in and do something specific for that tenant that's going to create value in the deal.
And as a result, they'll sign a 10-year lease with us, which creates a ton of value for us on paper, whether it's lending or whether it's to the capital markets.
Yeah. That'll be exciting to do that. But that's, we've got to go in and find that opportunity. Those are not abundant right now. Looking at that and finding like, hey, where can we get a specific tenant that has a lease and an owner where, they may or may not want to put capital in and we can move capital. It's like, those are slim to find them. But really, that's the only opportunity we're seeing in the industrial space is going after those positions. So we're kind of out of buying anything that's more suburban and big. Anything that's kind of fixed, long-term, non-value add. Those are not where we're seeing a good value proposition right now to be investing in.
Right.
So, cool. All right, well, that's it for our industrial segment. We're going to have updates on our other ones as well, so check in for those. Thanks for watching.